Welcome to Buy, Hold, Sell. My name's Matthew Kidman, and today we're talking about value and trying to find it. There's a lot of companies out there that seem awfully expensive, even if they are very good companies. Is that a conundrum we can solve here today? I have Prasad Patkar from Platypus and Romano Tenna from Katana. Welcome, guys. Romano, I'll start with you. Should we pay up for companies that are expensive? Because everywhere I walk around, I run into fund managers. They say, can't find anything cheap, everything's expensive. Should we just take that leap of faith?
Look, I think the first thing, Matthew, is to understand why it's expensive. There's some good reasons why companies are trading on lofty multiples. For example, they've got great quality of earnings, high EPS growth, early stage thematic. And I think as a general rule, they're companies that are worth having a closer look at. There's also some bad reasons though why companies are trading on lofty multiples. For example, a lot of media hype or company hype, momentum trading, FOMO, whatever. And I think they're the reasons that you need to be very cautious on.
How do we work that out?
Well, the first thing is to start by having an understanding of what's the intrinsic value. And the intrinsic value for high growth companies is quite a different metric. You've got to look at different ratios and look at things 2 years out, because what might seem expensive today will be cheap if you've got 15% compounding growth.
Okay, Prasad. So I pay up 35 times earnings. I'm going well. Company misses its earnings, it's down not 10%, but 50%.
Yeah.
That's the risk.
That is the risk.
How do we avoid that?
Well,
and do we steer clear completely of it?
Yeah, I think you just have to be a bit more hard on yourself in making those decisions, because that is exactly the risk. You've got to be eyes wide open when you get into these situations. If you buy a growth stock that is well loved by the market and well liked and well held, and it disappoints, you're going to get caned. So
how do we de-risk ourselves? Do we put our portfolio together and say the average price to earnings multiple for the whole portfolio, or is that not going to help you?
Well, that's the low octane version of buying, or that's a sort of an index version of your portfolio. I'd recommend that you'd rather do your bottom up analysis well and align your portfolio to your levels of conviction, especially when you size a particular position.
Okay, Romano, do we look at the price first or the business first?
Look, we certainly look at the underlying business. In Australia, there's only a handful of companies, or two handfuls of companies, that have strong, sustainable business models, and they're very well known, they're very well documented, and that's why they're trading on expensive multiples. What we would do additionally to try and prevent the issue of a high-priced company being sold down is to put a technical overlay across the business. So where we see companies that are trading above our intrinsic value, for example, high growth companies, would apply some technical filters, and where we start to see a change in sentiment, they'll pick that up pretty quickly and will move to the door. And in those situations, if a company is trading above our intrinsic value and sentiment's starting to crack, we're more inclined to move sooner rather than later. If a company is trading below our intrinsic value and sentiment changes, we're probably more inclined to hold on.
And Prasad, I'll put the same question to you. What's the most important thing to look at? The price of the business or the actual business first?
No, I think you start with the business, and what you pay for the business is a bit of an art. So you start with the business if you like it, and if you think it's expensive for what it offers in terms of its growth, its quality, then you have to be patient with it.
Okay, let's go to the macro side of it. Interest rates historically low.
Yep.
That tells me we can pay more for businesses because the benchmark's lower. Does that change how you look at a business and what you should pay for it?
Well, I think that's the way the market seemed to have moved, but there is an inherent risk in that as well, is as long as people are aware that that risk exists, where especially it manifests itself in certain sectors like REITs and infrastructure, that if you have a dislocation in the credit markets or sovereigns sell off, then you can end up with a drawdown of 20 or 30% in a very short span of time, as we've experienced in the last few days.
Okay, Romano, that's the same question to you. And we have seen it recently. You know, it's some very good companies trading on big multiples, whether they be infrastructure stocks, whether they be property trusts, and so on, seem to be way above what you'd normally pay for them. And they've fallen away recently with the idea interest rates going up. How important is that?
Well, I think you mentioned REITs and infrastructure. I think they're two very dangerous sectors for us at the moment. If you look at classically how they've been geared and the comparative value, I mean, REITs and infrastructure plays are priced versus what the underlying interest rates are. As interest rates turn up, they become less attractive, plus their cost of borrowing dramatically increases. They've been over-geared, many of these vehicles, so it's a very dangerous space. We take the view that you don't need to be on every bus. We want to be on buses that we are comfortable with, and if we're not, we're happy to sit out and let the market do what it does.
Okay, Prasad, let's go to the other end of the extreme. Do you actually need a quality business to make money?
With our process, we look for quality companies that have long duration in their growth cycles. So for us, yes, it does matter. But there are plenty of other processes which can work without that core requirement. And the other end of the spectrum is people who buy out, bombed out companies, restructure them or return them around and make plenty of money as well. So the answer is no, but our process relies on trying to find quality companies.
Okay, Romano, we all love to buy great companies at the lowest possible price, but assume that's not the case. We can't do that. Can we buy average companies at really low prices and make money?
Look, I certainly agree with Prasad that the holy grail of investing is great businesses at reasonable prices. That's what we're all trying to do, but of course that forces valuations into territories that we don't like to be in too often. I think if you turn that question around and say, can you make good money out of poor businesses? Absolutely you can. I think Howard Marks summed it up best from Moat Capital when he said that, when people perceive that something's risky, the lack of buying and the selling will reduce that price to a level where it's actually not risky at all. Mm-hmm. So if the risk margin, if there's a sufficient margin of safety there, then yes, you can certainly buy comfortably these companies and over time make good money.
So it is not beauty, but it is value that we see in the eye of the beholder.